My name is Andrew Kinnick, and I'm going to be giving the transactions and funding update today. So in terms of agenda, what we're going to go through, look at what's happening actually in the market in terms of transactions and funding, and also looking at things from a private equity point of view, because it is having an increasing impact, and the Southwest to a certain degree hasn't seen what's been happening elsewhere, and what it could mean for you, even if you're not looking to take private equity investment yourself. And then a very common question we get asked is looking at management buyouts and EOTs, employee ownership trusts. So looking at those and doing a bit of a comparison for those who may want to consider those as options going forwards. So no further ado, looking at the deals activity, what's been actually happening. We look at the table, we can see Q4 last year, there was a real peak as many people tried to complete transactions before the budget because of the concerns of what changes would come through. And for those who did, it was actually the right decision. They were in a better position. Since then, deal volumes have fallen down quite a bit, not just lower than that peak, but lower than they were before. About 7% down, but we're starting to see increased activity for people, again, wanting to complete deals before this budget. However, it varies across by size of deal as well, with the lower mid-market actually being more resilient and accounting for more transactions than historically. But with the budget coming up again, for some, this will stop them undertaking activity because they're just going to wait and see, or the negative impact it's been having on their actual trading business, and therefore their risk appetite for progressing now may be lower, or other parties' risk appetite is lower, so they'll actually leave things. However, there's still others that may be looking to do transactions and might feel it's a bit too late. Things like management buyout, employee ownership trust is still possible if people start fairly shortly. Rather than just looking at deal volumes, actually looking at valuations, we feel that people tend to hear the averages rather than seeing the variation that happens by sector. So there is significant variation there right the way across, and those in retail trade, those employing lots of people, having historically been more secure, have been hit by additional costs of that, which is impacting from a buyer's perspective. Clearly, we've seen other aspects in terms of opportunities, where people are going from a broader market, where people see overall with the likes of AI, software development, driving more growth there, and hence in terms of valuations being higher. So size does also come into account for this. So a smaller business generally will have a smaller multiple. The larger the business, to a certain extent, the larger the multiple. And this can add quite a considerable amount to the overall valuation. So what we're really saying is, please don't take just the average number, consider what sector you're in and the relative size before you actually try and do some numbers from your own perspective. Looking ahead, what does it look like? Well, there's a lot happening in terms of the market and what people are looking to do. There are a lot of factors affecting it, a number are listed out on the slide here. But underlyingly, there's still a significant amount of people saying, is it an appropriate time for them to do a transaction? And is it just them from their decision making? Or is it external impact? So are people getting approaches? Are there more approaches and more private equity appetite that's actually driving more approaches to businesses and business owners, rather than business owners actually deciding to do something their own perspectives? What we're also noting is a significant increase in the number of overseas acquirers. As they say, the UK is a good opportunity, and with exchange rates for many of them globally, the UK is a good cost-effective place to actually invest. If we look at it from the other side, from an existing business point of view, those that are doing well in suitable sectors, there is a significant amount of interest. For those where performance is not where it was, maybe due to economic or tax impact, certainly even if they do want to go to transaction, it may be harder because there is less interest, and it needs a far more focused, planned program to actually get a successful transaction away. Well, I think it's fair to say that some will view the fact they've waited for a while, and we all get older, and therefore we can't always just wait for the perfect time to undertake a transaction. So, as I've said earlier, we're seeing some increase, but not the level of increase pre-October last year that's coming through, as more people are taking a more longer-term view of when it's appropriate and what type of transaction is suitable. I mentioned at the outset in terms of private equity and it's having more impact. If we look at the various stages of private equity here, because the phrase private equity is viewed differently by many people, we start at the very early stage where there's sort of angel and seed investors, or venture capital as it's referred to, often will invest in businesses that are starting up, may go through a significant loss-making phase before actually being taken out or further investment from more traditional venture capital, where they've got growth aspirations, still yet to deliver it all from a profitability point of view. Once they're into profitable and it's more a question of the actual growth in that sector, it's the green here, then it's in traditional private equity. And by that stage, with the overlap with the risk profile having declined, that actually traditional banking will come in. Between those two, traditional private equity and traditional banking, as we've said beforehand, other forms of finance such as alternative finance are prepared to bridge that gap, taking higher risk for higher returns. What people will also consider under private equity is other things like family offices, where maybe a very successful family business is looking to diversify from their possibly shipping or oil and gas of many years ago to actually invest across a range of businesses. There will be other institutional investors and pension funds that are also can be considered as private equity because they're acting in a similar way. So in summary, there's a broad range of terms that are used to describe investors that will take an equity interest in driving business growth forwards. And just to put it in perspective, this is the very latest numbers to June 25, where we can see only 9% of the market in transactions was by private equity directly. That used to be the model, that private equity invest in one standalone business, help it grow, and then potentially in years to come sell it. There's now significant growth in what's called platform private equity investment, where they'll invest in a corporate that then itself does many acquisitions. We can see that substantial growth, and therefore taking into account the two, that accounted for 30% of the transactions in the last 12 months. That's a considerable growth and will continue to go forwards. And it's that aspect that you may start seeing having more of an impact in your marketplace than what your competitors are doing. From a Southwest point of view, it's been probably one of the slower areas of the UK to actually see this, because a lot of them were historically based in London or other major institutional cities of the UK. But we are seeing more come in, and they are becoming suitable alternatives to the traditional trade purchaser. They've also flexed significantly on the transaction structures they're willing to adopt, in a number of cases taking more minority stakes or allowing cash out rather than just looking at pure investment in the corporate entity going forwards. So providing that liquidity and funding and having an appetite to really take higher risk compared to those that may have only taken debt funding can give a very good environment for people in management teams helping to grow and survive in the current climate. So the final bit I would say here is there are still a lot of misconceptions about private equity, and the old asset strippers may still be around in some form, but that's a niche part of the range of private equity options that are available today. It's well worth therefore having an understanding of that so you can make an informed decision in your business and what's relevant for you. So having a look at this traditionally and transactionally, we could say it was very much about, as I said, those individual acquisitions of buy and build. But now a number of them will help that succession and change in ownership over a period of time, allowing people to take literally cash out today, and if they want to stay on, have further investment to grow the business. That in today's world, and those who've gone through the COVID era have seen how risk can fundamentally change, and therefore there may be some who do want to de-risk but actually still want to stay in the business. The final point there is, if you do decide to go down that route, there's far more money and thought process needed to go into it. There's more money than ever beforehand, but the thought process of what you can get. So each pound may be the same, but the providers of private equity funding can be radically different. And what I mean by that is the amount of support they can give for you and your business and helping it grow can in itself be transformatory. And the money aspect may be secondary to that. That clearly is not the way many people actually look at private equity, but it is a key part of consideration. Then we look at it and say, well, assuming you're not looking to do anything transactionally with private equity, be aware of the impact it's having in the market. We're seeing more and more sectors with, as we've seen earlier, that buy and build growth that actually means that your competitors may be taking private equity or being acquired by a private equity backed business. It will wake up some of those sleepy competitors. It will drive them further. what impact does that have from customers, from a staff point of view? And actually, are they in a position with funding to make more investments and take more risk to actually drive the business forwards? It's that aspect that is going to impact more businesses in the Southwest than we've seen to date. And hence why it's well worth considering being more aware of what's happening in your market and the ownership of your competitors, rather than just assuming if you don't want it, you can keep away from it all. Anyway, that's looked at from a private equity point of view. Now look at it, as I mentioned earlier, about management buyout or employee ownership trusts. These help successions actually occur, but actually, unlike a trade purchase that often is 100%, they can be done in varying proportions. This therefore gives more flexibility for the current owners, and in terms of that. And just briefly, the EOT, the reason why a number of people may have been approached about that and why they say they're attractive is because at the moment, if you undertake that, there is no capital gains on the transaction if it's undertaken in an appropriate way. So they can achieve total exits, but they can actually enable them to be done in a period of time to preserve more of the culture of the business and actually the legacy that the current owners may feel that they want to continue. So there are many different in terms of these. I'm going to run through some of these in a bit more detail on following slides. So if we look at it from the people perspective, first of all, the management buyout, the equity ownership stays with management and management oversight. But on the employee ownership trust, it will be the trust that's done it. And therefore, the rewards for the individuals will be less because in effect, it's spread over far more. In terms of the ongoing involvement, there's that flexibility in the MBO, but under the EOT to meet the conditions, to have it viewed as an employee ownership trust for tax purposes, it very much needs to be done, that it's controlled by the trustees of the employee ownership trust. So quite a fundamental difference that people need to take into account. By the time we look into who can get the value, as I said, the MBO will enable that growth in value to be shared with a smaller proportion of people. The EOT enables the bonuses to be paid out if the profitability is there, but there's less likely to be a subsequent transaction that realizes significant value that actually goes to staff at a subsequent point. On the next bit, when we look at the funding tax considerations, the bad are the business asset disposal relief is available as long as the criteria are met, and hence why at the moment the capital gains tax will be reduced by that amount if the conditions are met. From an EOT perspective, that tax rate is 0% if the criteria for an EOT are met. Picking up on one of the things like selling at least 51%, often those will be far higher, or 100%, because there's rarely a second transaction that follows on efficiently, will actually impact on the tax bit. However, it is well worth considering the value and in terms of the funding for this. Yes, management under an MBO may put some funding in, and it is very much suitable for debt and equity depending on the individual business. The EOT's perspective, equity can't go in there because they're not looking at a subsequent transaction, so it is debt. And because of the risk profile of it and it not being driven by a small management team, it is perceived as being higher risk, and therefore often the debt amount would be lower. So by the time you bring those factors to play, an MBO, the cash on day one is often significantly more than it will be on an employee ownership trust. And outstanding amounts can be for a long, long time because the vendor will have to wait until the business has generated the profitability rather than it being funded by external sources. From a valuation point of view, if you take into account those factors, you can therefore see that an MBO is often going to get a higher value from a perceived vendor's perspective, because the timing, even if the number is similar, will be of more importance to them. For valuation, though, an MBO advisable EOT, it is actually required for that. And when we took at some of the other factors, such as the culture, it really depends on the management team going forward for an MBO. The EOT is meant to be a longer-term, employee-focused approach. So, having gone through all that, when we do the summary overall, there is continued uncertainty in the market, not just anyway, but because of the budget, the uncertainty over the policy of government and what that will do to those things. We do see that driving more activity until the budget, but not necessarily to the degree that there was last time. And private equity, whether you're thinking of doing it or definitely not thinking of doing it, be aware that it can still impact on your business. So consider what you need to do if your competitors take it and how you can make your business robust for the future and that potentially more competitive environment. And from a funding point of view, do consider being appropriately prepared for that. That, as ever, is essential, but even more so in any type of transaction or event you're looking to do. And finally, in terms of the MBOs and EOTs, they are great options to consider, and really make sure you are aware of those so you can make an appropriate comparison of the options and benefits of each, or whether you do nothing or do a trade sale route or even funding with private equity, so that you can make the best decision for the market going forwards. So I wish you well with all of that. If there's any of those particular topics you'd like to cover in more detail, look at it from your own business point of view, please don't hesitate to get in touch. Thank you very much.